Before we briefly review what we've covered in the earlier segments, we'd like to recap a couple of issues of interest to community banks that cut across different segments of this video and different parts of the rule. We know that many community banks frequently use balloon loans, and we've talked about them in both the non-QM and QM context. Now let's pull together all the provisions related to balloon loans here in one place. Elizabeth and Glenn, can you give us a summary?
Sure, Serge. We'd be happy to. All small creditors that meet the asset and originations tests can write QM balloon loans until January 2016, provided they hold those loans in portfolio for at least 3 years. There are limitations on the balloon QM loan terms and features. 1, it must have a fixed rate. 2, it must be for a minimum of 5 years and a maximum of 30 years. 3, the points and fees cap applies. And 4, there must be substantially equal periodic payments calculated over a maximum 30-year amortization. And when underwriting the balloon loan, the small creditor would underwrite to the maximum periodic payment. It is not necessary to take the balloon payment into account. After January 2016, small creditors that serve predominantly rural and underserved areas may continue to write QM balloon loans. Note that the CFPB is considering changes to the definition of rural in a way that might broaden its applicability, so stay tuned. The rules also allow for non-QM balloon mortgages. As with other non-QM loans, you make a balloon loan by considering and verifying the 8 common sense factors in the rule that we discussed earlier. As with other loans with payments that vary, the rule tells you how to calculate the payment to use in underwriting a non-QM. You can find those details in the rule itself and in the CFPB's Small Entity Compliance Guide.
We've also mentioned that when creditors make their ATR determination, there are rules about what payment amount to use. Here are the basics on the rules that apply to adjustable rate mortgages. You can also refer to the Small Entity Compliance Guide and the rule for more detail. For a non-QM ARM, calculate the payment using either the fully indexed rate or the introductory rate, whichever is higher. And the calculation should be based on substantially equal payments that fully amortize the loan. For the general QM and the small creditor portfolio QM, calculate amortizing payments using the maximum interest rate that could apply under the contract in the 5 years after the first due date. And for the GSE eligible QM, refer to the GSE's underwriting guidelines. If you are writing an interest-only loan, and remember, you can write non-QM interest-only loans, the Small Entity Compliance Guide will tell you how to calculate the payment to use for underwriting those loans too.
Thanks, Glenn and Elizabeth. We hope those summaries are helpful. Now let's briefly review what we've discussed in this video. In the second segment, we went over the basic provisions of the ATR-QM rule and the types of loans covered by the rule. In the third segment, we discussed how to comply with the rule when making non-QM loans. Specifically, you would consider and verify the 8 underwriting factors specified in the rule. We emphasized then, and we emphasize again now, that these are common sense factors that you should already be familiar with and are probably already using in your underwriting. In the fourth segment, we discussed the presumptions for compliance applicable to QMs. There are 2 types of presumptions here, the irrebuttable safe harbor presumption and the rebuttable presumption. The difference between the 2 is the APR on the loan. In the fifth segment, we went through the standards for what it takes to make a QM. In the sixth segment, we went over which charges count towards the QM points and fees cap. In the seventh segment, we talked about supervisory expectations regarding QM and non-QM lending. Remember that one of our key messages here is that we as regulators will not require banks to make QM loans. We expect our supervised institutions to comply with all applicable laws and regulations, including the ATR-QM rules, but as we've hopefully made clear throughout this video, it is not necessary to make QMs in order to comply with the ATR rules. Finally, in the 8th segment, we provided some practical tips for putting together and maintaining an effective compliance management system for compliance with ATR-QM. We'll conclude by pointing you to some additional resources. Our Deputy Director, Jonathan Miller, will provide this information and close out our video.
Thanks, Serge. Although there are numerous resources about ATR-QM, we're highlighting the CFPB's resources, as the CFPB is the agency with interpretive authority for this rule. The CFPB has made many useful resources available on its website to facilitate compliance with this rule. The following resources available from that site that community banks may find particularly useful are: a special online version of the rule enables you to easily jump to the corresponding official interpretations. The slide lists the specific sections of Regulation Z that are relevant to the ability to repay and qualified mortgage provisions. The Small Entity Compliance Guide to ability to repay and qualified mortgages. The Interagency Examination Procedures and Narrative for Truth in Lending generally are also available. You'll find the examination procedures and instructional narrative for the ATR-QM rule, Section 1026.43, included there. There are several excellent summary charts relating to ATR-QM, including a guide to QMs for lenders. The CFPB has also prepared some charts that are particularly geared towards small creditors. We also referred earlier to interagency statements and a financial institution letter regarding the regulatory agency's positions on non-QM and QM lending with respect to safety and soundness, fair lending, and CRA. As a reminder, these are listed on the slide. This concludes our presentation on the ability to repay and qualified mortgage rule. We appreciate your interest and hope you found the information in the presentation to be helpful. Thank you.